Hello and welcome to this episode of Macro Sutra, the first one in 2025. I'm TCA Sharad Raghavan, Deputy Editor, and now the RBI recently came out with a lot of data and several reports on the banking sector. Now, things largely are looking good, but of course, there's no time for complacency because there are some risky signs in the future. So, to look at what the banking sector looks like as we enter 2025 and what the outlook is for the year, that's what we're going to discuss in this episode. And for that, we have with you Radhika Pandey, Associate Professor at NIPFB. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, when we talk about banking, the banking sector and its health and all of that, the first thing is NPAs, with non-performing assets. So, what is the situation with NPAs? And I know that the numbers have been going down, but have they been going down in what we can call a healthy manner?
Yeah, so first talking about the numbers, so they have gone down significantly. There was a time in June 2018 when the overall NPA ratio was more than 11%. That is when we talk about bad assets as a proportion of loans and advances, it was 11%. That was mainly driven by public sector banks because public sector banks' NPA ratio was almost 15%. And comparing to that situation, now overall banking sector NPA ratio has come down to 2.6% as per for September 2024 as per the Financial Stability Report. Huge improvement, and the main improvement has come from public sector banks because public sector banks GNPA ratio used to be, as I said, around 15%. It has come down to 3.3%, and private sector banks used to be 4.4%, not that bad, and it has come down further to 1.9%. So overall, broadly, there is a sharp improvement in the quality of banking sector assets as measured by the non-performing assets. Now, when we talk about what has driven this reduction, there are a number of factors. There are, of course, the traditional factors. The good factors have played their role. For example, recoveries and upgradation of loan accounts, that they have played their role. But particularly in this financial stability report, which came out on 30th of December, RBI has flagged that we cannot escape the proposition that write-offs have also been a very important, that reality is there, that write-offs have been a major contributor towards NPA reduction, and for some set of accounts. It's not that overall write-offs have been very prominent, but for retail accounts, for retail loans, there have been write-offs, and the concern that has been raised is that if there are write-offs happening in retail loans, it is masking the overall quality of loan accounts in the retail loan segment, and there also particularly in the unsecured loan segment. And that we've seen that since November of 2023, retail loans and particularly unsecured loans have been a focal point of policy intervention. So we've seen an improvement, but still there are problems as regards write-offs that are happening in the retail loan segment that would have contributed towards reduction in NPAs in the retail segment.
So then the good news also would be that credit to this segment is also slowing down quite sharply because the RBI took steps.
Yes.
So if credit, so then maybe the problem going ahead, I mean, there might be a problem, but it will be a lot smaller than it could have been if that credit had kept growing at the pace
Absolutely.
that it was.
So that intervention was needed, it was warranted, and we've seen in the data now that since May of 2024, credit growth to retail segment and credit growth to NBFCs has slowed down significantly. But there are some other, issues that we can talk about when we'll talk about NBFCs in particular. But yes, that is true that, if that intervention would not have been there, loan growth would have been much faster, and the amount of those loans turning into NPAs and the amount of write-offs that would have been required would have been much larger in scope.
Right. And some of the other metrics also paint quite a rosy picture of the banking sector. As you mentioned, the gross NPA levels, but even the slippage ratio and the actual additions of NPAs every year, the in
Yeah.
absolute terms,
Yes.
both have been going down.
Both have been going down. Slippages have gone down. More importantly, the large borrowers, because if you remember the credit boom and then subsequently the banking sector crisis that we faced in 2011-12 onward, that was mainly driven by large borrower accounts.
Yes.
Now, this time around, what is very notable is that large borrower accounts are not contributing towards NPA. So that's a very welcome development.
Right.
Though there are some pockets of concern, because there's another term which is called special mention accounts. So what is NPA? NPA accounts are those where principal or interest payment remains overdue for more than 90 days.
Right.
Now, special mention account is SMA 1 and SMA 2. SMA 1 is where the overdue is for 30 days, up to 30 days, and then 31 to 60 days is your SMA 2. So there are these some emerging signs of stress, particularly in large borrower account. But overall, if we see the position, large borrower accounts are not contributing to NPA, which is a very significant development and has a bearing on the health of the banking sector. That even if there is stress, that will emerge from the retail unsecured loan segment, which has been curbed to a large extent due to increase in the risk weights.
Right. And also the thing with these large borrower accounts is that, of course, then your risk is very concentrated.
Right.
That if one borrower defaults, then that's a significant chunk of bank lending, or it can be a significant chunk. But because now the stress is distributed across retail loans, all of them are relatively much smaller, it would take a large amount of defaults across all of these loans for it to become a problem. So the risk is a little more spread out. So that's a positive sign. But apart from that, there are some signs of incipient stress in the
Right.
system, right? Could you tell us a little more about those?
So one thing is about the profitability of banks, because again, the capital position and profitability both have seen significant improvement. We are still above the what is required as the regulatory minimum threshold. The capital position is above that.
Right.
Profitability also measured in terms of profit after tax growth has been 22%, which is again quite robust. Now, the point to note is what is driving this profitability. Now, there we have seen a structural change happening from the last 2 years. Because remember, last 2 years were periods of very high credit growth,
Right.
high interest rate on loans, and also a period of monetary policy tightness. So, banks could increase their interest rate on loans, and the loan credit growth was also faster. Now that is now changing, because now if you see credit growth and deposit growth, there is the wedge between credit growth and deposit growth is narrowing.
Right.
Credit growth has slowed down appreciably as compared to the high growth period that we saw in 2022 and 23. It has come down, and if we see in 2025, maybe not in February, but in April, if growth remains slow, there could be monetary policy easing, which would further have a bearing on the loan rate, on the rate of interest at which advances are given by banks, because at least for private sector banks, most of the lending rates are now benchmarked to the repo rate. So all these factors will lead to compression of the net interest margin, because the loan rate that you can charge will not be that higher. And because deposits are being sluggish, they have not picked up. So banks are relying on high cost certificate of deposit. They are raising funds through certificate of deposit. So the net interest margin is shrinking. The cost of funds for bank is rising. So typically this was the factor. Net interest margin was the factor that drove profitability in the last 2 years.
In the past, yeah.
But this year, net interest margin has not driven the 22% growth. That has not been the significant factor. The significant factor is other operating income, like dividends, like investment income. You are getting interest on from your treasury holdings and so on,
which might not always be
which
the
might
case.
not always be the case. But net interest margin was a significant driver of profitability over the last 2 years. This time there has been a change in the composition of the drivers of profitability. So that is one thing to note, that but because it is understood that going forward the net interest margin of banks would be under pressure. So it is the other sources of income that would have to do the heavy lifting to ensure that banks maintain that high level of profitability that we have seen. So that is one element of it's not stress, but something that needs careful monitoring going forward. The other, we've already spoken about that, there are slippages happening in the unsecured loan segment that needs to be monitored. There are write-offs happening in the mainly by private sector banks for the retail loan. So these are 3-4 concerns that have been raised in the financial stability report that needs careful constant vigil going forward.
Right. And the other area of concern that in the past the RBI has talked about is the interconnectedness of the banking sector and the non-banking financial companies, the NBFCs.
Right.
And they said that this is creating a little bit of stress because stress amongst the NBFCs then can get transferred to the banks.
Right.
Has the situation improved now?
Yes, so there the situation has improved again because of the regulatory intervention that RBI did in November 23, where it increased the risk weights. And so we've seen now, if you look at compare the early 2023 period with the latest November data that has come in the last week of December, we see that in the early part of 2023, bank credit to NBFC was growing at almost 30%. Right. And now it has come down to single digit to 6 to 7%. So that bodes well for financial stability because the bank NBFC nexus is being weakened. It's not that strong that any systemic risk that we see, any chances of default that happen in NBFCs, that would not get transmitted because banks' exposure to NBFC borrowing has slowed considerably. Yeah. Now, there are two things here. There are two ways of bank and NBFC. There are two channels. One is bank lending to NBFC, and the other is banks' investment in NBFC's debt paper. NBFCs are issuing corporate bonds. Right. Banks are investing. Now, in both of the, when we see these two factors in conjunction, we have seen that banks' exposure to NBFCs has come down. Okay. So that is a positive development. On the other hand, NBFCs do need funding, so they will shift to non-bank sources of funding.
I was going to ask you that. Is that a risk for NBFCs now?
Yeah. So there are again two major channels through which NBFCs are borrowing. One is through the issuance of commercial paper, which is a short-term money market instrument with a maturity of less than 1 year. So they are raising funds through the issue of commercial paper. The other is through the issue of corporate bonds. There is not a problem there as of now because we are seeing that, remember during the IL&FS crisis, before the IL&FS crisis, mutual funds used to invest a lot in NBFC's paper, and that came down. And now again, after November 23, we see that the mutual fund subscription of NBFC's bonds and commercial paper is rising. So we do see a structural shift again in the NBFC sources of borrowing, where issuances of bonds, issuances of non-convertible debentures, commercial papers have increased considerably, raising of funds. But the concerning element is that some of the NBFCs are also borrowing through foreign currency loans. And that is where the concern is, because if you are borrowing and if you are not hedging your foreign currency exposure, that could create systemic risk. And that is one thing that the RBI's financial stability report has flagged.
Right, especially with things like devaluation of the currency.
Yes, and dollar strengthening, and we don't know how much rupee will depreciate. We don't know how much RBI will intervene, because now there are indications that RBI has scaled back its level of intervention. Right. So it's very important to hedge foreign currency exposure, and to the extent that foreign currency borrowings are unhedged, there could be some sources of risk. So that is one source of risk that going forward would need to be monitored, because dollar is going to strengthen, and these risks could increase in the coming days.
Okay. And now we've talked about unsecured loans from the banking side of things. Right. But what does it also say about the level of indebtedness of households, of the people who are taking these loans?
Now, that's a very important area and which requires consideration and discussion. And because we've been talking about retail loan, we've been talking about household borrowing from bank. But always the natural question that arises is that who are these households and what are they borrowing for? And this is where the Financial Stability Report sheds some light. It tells us that households are borrowing for what purposes, and whether the increase that we have seen, is it due to intensive margin or extensive margin, meaning that the same borrowers are borrowing more, or is it that there are more number of borrowers accessing banking sector loan. So here two things. Firstly, the report says that the households are borrowing for primarily three purposes. One is for consumption, one is for acquisition of assets, and for productive purposes.
Okay.
Consumption means for consumer durables and so on. Acquisition for, say, housing, real estate, and productive purposes could be agricultural loans and so on.
Or
So,
investing in your own practice, like say if you're a doctor or a lawyer or
absolutely,
something.
yes. Investment in your plant and machinery. So there could be, so those are the three loans. And what they are saying is that, the high quality borrowers, or the term they use is super prime borrowers, they are borrowing mainly for investment purposes. They are not borrowing for consumption purposes. And it is these borrowers where we have seen an increase in the per capita debt. We have not seen increase in the per capita debt of subprime borrowers. Okay, so the increase in per capita debt is happening for super prime, or we can say high quality borrowers.
But that's a good thing.
That's a good thing. So they do have the ability to repay back. So though there is some increase in the per capita debt of other kinds of borrowers, but noticeably there is a sharp increase in the per capita debt for the high quality borrowers, which is a good thing, which doesn't lead to any concern as of now from financial stability perspective, from the perspective of build up of a bubble which could burst, leading to some crisis in the banking sector. So that is a good thing, that allays concerns about the fact that we were talking about this high consumer loans and debt servicing capacity. But what the report says is that the debt servicing capacity is higher for high quality borrowers, and it is those borrowers whose per capita debt has risen. But the point to note is that overall household indebtedness has increased over the last 3 years, and that nevertheless it needs to be monitored.
Of course.
So it has now increased to almost 42.9%. So that is something which needs to be monitored. But overall, the composition is not something that raises concern as of now.
And those people who've been borrowing for consumption and all of that, they aren't at risk of or higher risk of indebtedness or even default?
Yeah, so that is what the report says, that they are not, because there is increase, as I said, there's increase in number. It's not that they are borrowing a lot. The same thing that you mentioned for retail loan, it's not concentrated, because there is the increase has happened due to increase in the number of borrowers rather than increase in the amount of borrowers. So that again tends to diversify the risk and not lead to concentration and systemic risk concerns. So through all this, we see that as of now there is we don't see much cause of concern as per the report. But as I said, overall numbers are rising, and that is something that needs to be monitored, because anytime situation can change. So
yeah, of course. And okay, so we have a few questions from the audience. Aditya asks, what according to you has been the reason that public sector banks have been able to perform better than private banks in terms of bad debt loan management? Is it strictness adopted by the management or special attention being put by the RBI?
it's both. Firstly, we should, as I mentioned initially, that there has been a sharp decline in the GNP ratio of public sector banks. There was a time in 2018 when there was a large, big differential between the GNPA ratio of public sector banks and private sector banks. Public sector banks almost 15%, private sector banks 4.5%. And from there, we have seen now a decline to 3.3%, which is quite significant. And there are a lot of factors, both from the perspective of public sector banks and private sector banks. From the perspective of public sector banks, what has happened is that RBI has improved its regulatory scrutiny in the form of PCA, prompt corrective action
Right.
framework. We saw there was a time in early 2020s when a lot of public sector banks were under prompt corrective action framework, which required that a lot of regulatory restrictions are imposed. They cannot repay dividend, they cannot increase their branches, they cannot access more deposits. So there are a lot of restrictions unless they improve their asset quality and return on assets. So that did result in improvement of their various performance
Absolutely.
indicators, and slowly and gradually we saw that most of the banks are now out of the PCA
Actually, by
framework.
now, I think all of them
All are
Yeah.
out, yeah. So all are out of the PCA framework. So that is one thing which has resulted. On the other side, private sector banks have been, concentrating more on increasing their profit margin, their NIM. So they have been recklessly lending, some of them, to retail loans and unsecured lending. And so
Right.
that has resulted in shrinking of the profitability differential between public sector banks and private sector banks. So there are some factors playing out from the public sector side as well as private sector banks.
I mean, you would have seen because amongst these unsecured loans are also credit cards, and you would have
Right.
seen the profusion of credit cards out there, and the way that these companies are pushing them on you. They're calling you, they catch you in the malls trying to sell it to you. So all of that has also been happening. So Vivekanandan asks, will the depreciating rupee be any help to the banks? The exporting companies should receive incremental rupees, and importing segments may spend more rupees for the same product volumes. So in rupee terms, will it help boost bank performance? Will the current account, savings account, or the CASA deposit, or the balances, will those go up due to this?
Yeah, so firstly, a very good question. And if you look at the RBI's financial stability report, we see that the growth of CASA deposits has been lower than the growth of high cost term deposits. Because now, if banks have to garner more deposits, they have to give higher interest rates. So the incremental deposits that have happened, most of them are the term deposits
Right.
rather than CASA deposits. So that is number one point. On the point of rupee depreciation, there are two opposing factors at play. One is certainly it is true that when the rupee depreciates, there could be more export income, which could lead to higher rupees or higher inflows into the CASA deposits,
Right.
and it will swell the deposits. But at the other, the opposing thing that is happening is that the foreign currency borrowing of companies is also rising. So that could
Right.
lead to, and given that rupee is depreciating and dollar is becoming strong, when the company has to repay more in terms of rupees, that could lead to lowering of CASA deposits. So ultimately, it depends upon banks' exposure to its borrowers. What is the nature of borrowers? Are they more in the nature of infrastructure companies that have taken rupee loans, or are they who have taken foreign currency loans? So it all depends on that. But at the same time, there are various offsetting factors are at play. It's not just a export story playing out, depreciation leading to higher export revenue. That is one side. But at the other side, foreign currency borrowing will also increase, become more costly due to rupee depreciation, and that will offset the gain that could happen due to increase in the export revenue. So composition of the bank's borrowers is very important. And the other thing that is happening is that there is a continuous conscious effort towards moving away from CASA deposits towards term deposits.
Right.
That is also happening, and there is this whether from the viewpoint of government or from the viewpoint of companies, from the viewpoint of efficiency, they want to keep less money lying, cash balances lying idle in CASA deposits, and from the viewpoint of operational efficiency, there is a shift from CASA deposits towards the term deposits. So all these factors are playing out, and which factor will outweigh which factor is the time will only tell.
It's tough to say, but I mean, of course, there are also other factors, like just as a depreciating rupee helps exporters, it hurts the importers, right?
Right.
So the importers might end up spending
Paying.
a lot more rupees to pay for their imports, which means that their CASA deposits would start shrinking. And whether how that balances against the increase due to from the export side, I mean, we'll only have to see, because you have to see whether imports are growing faster than exports or exports growing faster than imports. So there's a lot here. But overall, that's what we have for you. The banking sector looks in a healthy position. Things that there's no doubt about that. Things the NPA ratio is down, profitability is up, but the thing is that there are some headwinds in over this year that are going to unfold. One is that unsecured loans, delinquency there is starting to rise. It's starting to rear its head. It might be under control because the RBI took early steps to ensure that the growth in these loans started slowing down. So it won't be as big of a problem as it could have been, but it's still a problem to keep an eye on. The profitability of banks will also be under pressure as the net interest margins start shrinking. So that's another thing that banks are going to have to look at. Apart from that, there's obviously all of the how the rupee depreciation plays out and all of that. So the banking sector, in short, is on a strong footing, but it can't be complacent. It can't assume that things are only going to improve from here. It needs to be watchful of several emerging risks. But on that note, that's all from us. Thank you so much for watching.